exactly how worried should we be about Red Hat? The open source software company is so integral to helping businesses embrace the cloud that we named one of our cloud kings here. But 2 days ago, Red Hat reported its second not-so-hot number in a row. Now, this stock has a tendency to sell off after earnings, even when the numbers are really good. Historically, these pullbacks tend to be I would call them terrific buying opportunities. But that's not what happened this time. And you have to wonder if something's changed here to make the story less attractive. What happened? Red Hat reported a modest bottom line beat and a modest top line miss. However, just like last quarter, they cut their full-year sales and earnings forecast. And this time, management indicated the pricing is getting more competitive, with a rival software provider stealing away some existing business by undercutting them on price. Stock got slammed in the news, and it's now down 24% from its June highs. Question is, has Red Hat been punished enough? Can this fast-growing cloud play get its groove back? Let's take a closer look with Jim Whitehurst. He's the president and CEO of Red Hat, who's a real straight shooter. We got to figure out what's going on here. Mr. Whitehurst, welcome back to Mad Money.
Jim, it's great to be back. How are you?
All right, Jim, I've got to tell you, I'm a little concerned because, I think you're a terrific CEO and you have a great company. The bulk of your business is in enterprise Linux, and it grew at 8%. And you're one of our cloud kings, and we're not, it's unacceptable to grow under double digit. In terms of being a hyper growth or even a very aggressive growth company. So what's happening here?
Well, we talked about this at the beginning of the year, Jim. 3 years ago, or 2.5 years ago, we started down a path of trying to get our customers in 3-year agreements. By getting them in 3-year agreements on Linux, it gives us time to go then sell them new products. And the problem with that is those 3-year agreements are typically fixed, and so they don't go up in value every year. So the bulk of our Linux business in these 3-year deals isn't growing at all. Now, they will next year when these first round of 3-year deals come back up for renewals. We talked about how next year, with a lot more renewals from those, you should see more growth. But for right now, that's a key driver of it. We did say we expect this is the bottom and it should reaccelerate from here. We have good visibility, and our total backlog grew 20% this quarter. So we have a pretty good sense that it'll accelerate from here.
All right, well, I know that you've been saying that. The thing that I'm concerned is, well, first, I got to ask you, is there any chance that things have been, the revenue drivers saturated, that there's just not enough customers left out there?
Oh, not at all. I mean, if you look at the macro drivers, just for Linux, which is our traditional business, it continues to look really, really strong. The vast majority of the workloads on public cloud are Linux. We've shown that our customers stay with us when they go to the public cloud. The vast majority of net new workloads are on Linux. So whether that's big data or analytics or anything web-oriented, the vast majority on Linux. Even Microsoft says now that the majority of their new workloads on Azure are Linux. So the market's growing very, very nicely. So we're not concerned about that. It's just as we've locked customers in these longer-term agreements, we really have to wait till those renew before we see a lot of growth. And again, I think that overshadows the fact that our big pushes into the cloud around things like OpenShift, it continued to grow really fast. We added over 100 customers, and so the cloud portfolio is growing really, really fast, and we're really pleased with where that is as well.
All right, well, how about the rare competitive loss? That's a quote from you, to an on-premise provider. I know it was on price, but Jim, your offering is so much better than anything on premises. I can't believe that you lost something on price.
Well, look, I mean, this is one of these ones. If you look, we talk about the top 25 deals every quarter. Over the last 3 years, or that 300 deals, we've had 2 competitive losses that haven't come back. And so to some extent, do we want to cut our price, or are we okay with somebody trying something else and then typically they come back? And so we've only had one other customer beyond this one, which went away and didn't then later come back. And so again, if you win all 300 out of 300, it probably means you're underpricing. So I'm okay losing one every now and then, let the customer try something else and then realize the value of what we do. And typically they do come back. We've had other losses where they come back.
All right, I read a piece by Eric Johnson. He interviewed you at The Street, and you talked about actual slowing of your JBoss middleware business, that you said that culturally, basically, there's been some changes in the way people do things. And that worried me because that seems like a secular decline.
Well, yeah, so we have two pieces of our middleware business. We have what I'll call the traditional middleware, which is the Java application server for, you'd say, older heavyweight applications. And that we've talked about for a while will slow. It is being replaced by our newer middleware, which is embedded in the OpenShift portfolio, with our messaging, with our API management, with our rules engine, and those are all growing quite nicely. So what we talked about, there's some optics in the middleware business, but overall, that portfolio, if you look at middleware and emerging, is growing over 30% and continues to be really healthy with really good customer adoption.
All right, well, that's good. I wanted to hear that. Now, how about a big strategic partner for you? I mean, maybe an Amazon, a Google could be your partner. I mean, right now, Microsoft, nominal partner, IBM partner, but how about somebody really huge that you could just land that would make it so that I would feel better about the growth?
Well, look, we announced a big partnership with Microsoft. We announced a big one with IBM. We work very, very closely with Google and Amazon. So right now, a large piece of OpenShift, which is our container platform, actually does run on AWS. And last year at our conference, Andy Jassy and I did a whole piece on OpenShift on AWS and how it runs really well there. As a matter of fact, our dedicated service is there. So they're actually a really good partner on the public cloud side as well in terms of our container platform. Google, we made some announcements with. They do have a competitive offering, but I'd say AWS and Microsoft are both very big partners and big drivers of our next generation portfolio.
Okay, fair enough. Jim, I'm glad you came on this show. That's Jim Whitehurst. He's the president and CEO of Red Hat. Says there'll be an acceleration coming up. Maybe that's what will get the stock moving in the right direction. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.